Good morning and welcome to the Weekly Insight by John Plassard with Cité Gestion. Current volatility is no longer a temporary disturbance. It has become the core regime of financial markets, driven by the war between the United States, Israel, and Iran, Donald Trump's shifting statements, and persistent tensions in oil prices. What makes this phase unique is the combination of geopolitical shock and unpredictable US policy stance and a less supportive monetary backdrop. Since the beginning of the conflict, markets have been reacting to contradictory signals. Donald Trump alternates between threats, diplomatic openings, and delays in decision-making, particularly regarding potential strikes on Iranian energy infrastructure. With every shift in tone, oil futures, the dollar, and equity indices react immediately. As a result, markets are now driven less by economic fundamentals than by politics, war, and headline risk. Yet, despite this backdrop, the market decline remains relatively contained. Historically, a 5% to 7% pullback is more of an adjustment than a full correction. Fear is present, but it has not yet turned into systemic panic. Equities are pricing part of the risk, but credit markets are not signaling distress comparable to 2008. The market is therefore oscillating between a temporary geopolitical shock and a more durable macroeconomic deterioration. The Strait of Hormuz remains the true epicenter of the crisis. As long as this strategic passage is not fully reopened under normal conditions, the oil market will remain structurally tight. Even a ceasefire would not immediately restore normal flows, as shipping security, insurance conditions, and operational stability would still need to be rebuilt. The Fed is now acknowledging that the oil shock threatens the monetary outlook. If oil remains elevated, disinflation slows, inflation expectations rise, and the central bank becomes more cautious. Investors can no longer rely on automatic rate cuts to cushion the shock. In this environment, the correct approach is to focus on cross-asset consistency: oil, credit, rates, the dollar, and sector behavior, rather than equity indices alone. Portfolio strategies should emphasize quality, liquidity, diversification, and discipline. Volatility creates risk but also opportunity, provided investors remain selective. In periods of uncertainty, performance comes not from speed but from method. Thank you very much. Have a great week. Stay safe and keep on winning.